So much pollution. Isn't there a way we can incentivize businesses to pollute less and maybe make a little money in it for ourselves? Actually, we can. The concept is cap and trade, and the carbon ETF is what makes us money. It's a unique fund that mimics the return of carbon allowances within the cap and trade system. By the end of this video, you'll understand what that means and how we can make money from it. And carbon pricing has a very low correlation to other investments like stocks and bonds, which means diversity for our portfolios. So in this video, we'll learn what are carbon allowances, how can they make us serious money, and how to have fun doing it. Well, because saving the world and making money are both fun. Human activity generates about 1,000 tons of airborne carbon dioxide every second, warming our planet and changing our climate. This CO2 comes from many sources like power plants, agriculture, and transportation. Governments are tackling this climate emergency by incentivizing businesses to reduce their CO2 emissions. One such method showing promise is placing a price on carbon emissions. Not putting a price on it because it's for sale, but putting a penalty on it if a business releases it into the atmosphere. In addition to a price, the government puts a limit on how much CO2 they allow a business to release. As an investor, you need to understand what carbon allowances are and then what cap and trade is. The government hands out these carbon allowances to businesses and industries, allowing them to emit a certain amount of CO2. And if a business needs to emit more CO2 than they are allotted, they have to buy extra allowances from other businesses at a price determined by open market. The carbon ETF, KRBN, taps into this marketplace. By owning shares of the carbon ETF, you effectively own carbon allowances that other businesses are looking to buy. But you aren't a business, you're a buy and hold investor. With your carbon, buying this ETF drives up the price of carbon by eating away at the limited supply. Imagine you ran a business that made metal pipes, but the creation process of heating metal and forming the metal into a pipe shape and then shipping the pipe on a truck. In that imaginary process, you might emit, say, a ton of CO2 every single day. As an imaginary business owner, what are you going to do after you run through all your carbon allowances? If I'm a business owner, I know what I would do. I would go to the carbon market and I would buy more allowances, no matter the cost, because I can't generate revenue for my company if I can't emit greenhouse gases in this specific example. So these carbon allowances are very valuable to high pollution businesses, which makes them very valuable to your portfolio. Wait until you see the projections for just how expensive carbon allowances might get. More on that in just a minute. But because you understand carbon allowances now, you have to ask, what is cap and trade and how does it make me money? There's a cap, a ceiling on how much CO2 a government allows businesses to release each year, collectively. And any excess or leftover carbon allowances that a company has on the books can be traded to high polluting businesses. Traded meaning sold for a profit as their reward for polluting less. That's what we're buying with the carbon ETF. That's our investment thesis. We're jumping into this market, eating up the limited supply of extra carbon allowances that businesses strongly demand. If you're with me so far, it's pretty obvious why this ETF piqued my interest, but our investment thesis gets better. To further incentivize companies to pollute less, each year these governments issue fewer carbon allowances than the year prior, predictably lowering the supply of carbon allowances available for trade, making our buy and hold allowances in the carbon ETF worth much more. That's cap and trade. Hit that like button if you feel like a climatologist. If you just learned how to solve the world's CO2 problem, you are welcome. So what happens to your money once you buy this ETF? How's this gonna grow in value and what are the projections? I've got 3 expert projections for you. First projection is from 2014, so 7 years ago. The forward price of carbon was projected to be about $30 per ton as of 2020. What is it now, you ask? Well, it varies by region, but today, on average, the price of carbon is floating around 30 bucks. I'd say that was pretty accurate projection. Looking further with this same 2014 projection, there's significant growth potential of 2, 3, even 4x returns on carbon allowances, aka carbon investments. That's the first projection. Looks good for us. Projection number 2. Did you know John Kerry is a big environmentalist? I know he's a statesman and an advocate for growing gray with no shame. But yes, he's actually an environmentalist as well. And until recently, he was a special advisor to the index behind the carbon ETF. What do you have for us, Johnny?
And ultimately, hopefully, establishes a global price per ton for carbon. Right now, it's quite low. The experts say that in order to have an impact, to be able to really do something, it's going to rise up to 100 or above that, well above that. And what we're doing is trying to attract people to this marketplace.
$100 a ton? That's a 3 to 4x return from today's price of around $30 a ton. This interview was almost a year ago. Since then, Kerry has resigned from his role with the carbon ETF. And that's because he accepted a position with the Biden White House. He is now the U.S. Special Presidential Envoy for Climate. Big official title. Do you think he'll be taking those same aggressive opinions about pricing carbon at $100 a ton with him to the White House? Whoa, $51 per ton of carbon? And actually, the Biden White House says that could be revised up to $125 a ton after a more thorough analysis. How could anyone have predicted that? Here's a third projection that you're gonna like even more than the previous two. Meet Kate Rickey, respected climate scientist and leading thinker on carbon pricing. She projects that the average global price of carbon would need to be $150 to $200 per ton for sustaining impact to be reached. So there's 3 projections by experts as to how our selfless investment of saving the planet will grow to 3, 4, even 5x our starting money. It's hard work saving the planet. I'm just doing my part. All this is good news, and the current price is still just 30 bucks a ton. Would you agree there's a ton of room for an investment in carbon allowances to grow? And KRBN could get even hotter if the holdings start to include more cap and trade markets from around the world. Currently it includes California, New England, and the EU. But China is expected to come online this year. And the folks at Crane Shares have already assured us they'll be adding more cap and trade systems to the ETF as they become available. The EU is no stranger to carbon pricing. This isn't new for them. Sweden's price, for instance, also aggressive, is 126 bucks a ton, the highest of any country in the world. In fact, the recent performance of the EU's cap and trade system, which includes Sweden, validates just how much carbon allowances can appreciate. Did you know, this is gonna blow your mind, did you know that carbon allowances in the EU were the best performing global commodity for all of 2018 and 2019? Carbon, not copper, not oil, carbon. I know, I was shocked too. Go back to Sweden for a second. $126 right now in 2021, but they've had a price on carbon for 30 years. In 1991, their price was 20 bucks a ton. That's a proven increase of 6.3% a year annually. Not bad for such an under-the-radar investment, wouldn't you agree? The World Bank says carbon pricing is already implemented or planned to be implemented for 22% of the world's greenhouse gas emissions. That's great for us because 78% of the market hasn't even been tapped yet. In other words, there are industries and regions that are completely free from carbon pricing. And Crane Shares has told us they're ready to add new regions to the ETF. Let me ask you a question. Do you like your ice cream with cherries on top? Well, here's a cherry. Carbon allowances are a hedge against losses that these fossil fuel industries will certainly face in the future. I have exposure to these industries through indexes, whether I want to or not. You probably do too. The carbon ETF is long-term downside protection. It really is. Carbon allowances could also hedge against credit downgrades or environmental lawsuits against these carbon emitting companies. And carbon investments hold the potential to be a deflationary hedge as well. As more buyers flood into the carbon market, those that already hold carbon credits will have a deflationary store of value since supply is limited. Think back a couple of minutes ago when I shocked you with the fact that carbon has outperformed all commodities over the 2-year period of 18 and 19. Check out how little carbon has correlated with stocks, bonds, oil, and gold. I'm getting diversity and outperformance. That's the investing holy grail. There aren't many negatives or risks to this investment thesis. I'm sure you see this by now. But here are the 3 biggest risks that might come up. The first is, what if atmospheric CO2 was no longer a crisis? What if some incredible science fiction-esque invention completely eliminated carbon emissions from the planet? It would be great for the planet, but it would probably make carbon allowances pretty worthless. Second is the risk of political obstruction, because environmental policies wax and wane as politicians with varying ideals come in and out of power. Take our current federal standard, which you know has just increased to $51 per ton. President Trump, during his time in office, set the price under $7 per ton. As the carbon allowance enforcers, government participation is vital to the continuation of cap and trade. I think the diversity of the carbon ETF's holdings will get us through any isolated political turbulence. As more cap and trade systems are brought online and subsequently added to the ETF, our diversity grows further. The third risk to us as investors is cap and trade's cousin, carbon tax. Remember, cap and trade allows excess carbon credits to be sold for profit as a reward for emitting less CO2. And the existence of this market, this trading system, is what makes carbon investable for us. So what's a carbon tax and how is that different? It's similar, but is just a tax or financial penalty levied on companies who emit CO2. There's no trading system, no place for businesses to buy and sell carbon allowances, just a fee collected by the government. And a business pays less tax, less fees by emitting less CO2. Climate scientists and economists have said that both a carbon tax and cap and trade offer the same positive result for the planet, minimizing carbon emissions to slow warming. But if governments move away from cap and trade and embrace a carbon tax instead, the carbon ETF is at risk. By the UN's count, the 2 systems are deployed evenly at the moment. Carbon tax is really just the silver to our gold. Just like there are 2 main precious metals to invest in, there are 2 carbon systems being implemented. Both reduce emissions, only one is investable for us in a market. As with any investment, there are risks involved, but this one appears to be a rare one that the potential risks all appear to only limit the sky-high potential for this investment. And it's why I will be personally investing in the carbon ETF ticker KRBN. So let me know down in the comments below if you will be investing in KRBN and will help to save the world while making money at the same time. Thank you for joining.